Hey, what's going on everyone? It's Alan here back with another video. I hope you guys are all having a wonderful day. As always, today we're going to be going over Jim Cramer's March 25th, which is Thursday of this week, his Mad Money, okay? So as always, make sure you guys do subscribe to actionalertsplus.com. It's a great service where he has a charitable trust and he shows all his trades 45 minutes before he actually does the trade. So it's very good, and he always provides an explanation for why he's exiting, why he's going into a trade, why he's trimming, what's his thesis, what's his price target. Very, very nice service. And then also the real money column that he posts on every morning. So then let's just get to quick buy and sells, buy, sell, and holds here. Again, he's focusing on same old things, cyclicals, right? We want to make sure that our financials are we're in some sort of bank stocks. Wells Fargo, he said, was very good at 36, but obviously it's been going up 38 and, high 38s, I think, since it last stopped trading. And the industrials, right? Industrials are very important. We'll get to that later in the segment. He talked about Abbott Laboratories, and what he said is that they have a very good diabetes glucose monitoring system that you would be buying it for, and even their surgery component. But the call was regarding oil. Oils went up to, $1.70, per barrel, and now it came down to, I think, 63, 65. Jim Cramer says, the Saudis don't want it going past that range of $65. Then they'll just increase the amount of supply that exists. So it is going to be a good time to trim some of the oil or sell the oil and get into Abbott here. And then we have Fast Acquisition, which is another one. And then we have Virgin Galactic, which is another space travel company. He said if you're young, that being 20 or 30, okay, it's okay to, get a position, because space travel might just be the future. However, he said that, if you're going to be in your 40s and 50, don't worry about it, because it may take 40 years for something to actually happen, right? So the caller was in his 23s, I believe. So it's always better, when you're younger, to get in more spec stock like space, or I should say Virgin Galactic. And then for the sales, again, we're selling TAC into profits, right? Trying to trim our TAC and then circle that money, any of our, any of our profits from there into, or even, any cash that we're able to take from tech and growth, circle it into these great reopening cyclical plays. And then we have our SPACs here. Obviously, if a stock runs up 50%, take out your, cost bases, whatever you have to do. So that way you're making sure that, you're in a safe position. Counter trend rallies was his, kind of first segment here. So here, he kind of talked about stages of grief, right? He started off by talking about stages of grief, how he's went over this in the past, but we see denial, anger, bargaining, depression, and acceptance, right? So we kind of have to get into each one, and kind of, to understand where we are right now. Right, Jim Cramer just wants to, he starts off by detailing that we have not yet, fully reached acceptance, but we have to start planning for acceptance, right? Everything in the stock market, you should be able to plan in cool times. Even though now may not be cool times, you need a plan before that event actually happens. So you plan with a cool head is essentially what it is, right? So a lot of people are still in the depression stage, or the depression moment is what that still means. And this is where some investors will be giving up on the entire asset class. Acceptance is when they just say, they're gone from the entire stock market, right? So let's get into kind of what each one of these are. So first, what investors feel, and this is just general psychology, but psychology, I feel like, drives the stock market, really. It's how people are acting, on their beliefs. So the first thing that we see here is denial. Right? What exactly is it? It's when, the high-flying, speculative stocks, such as the SPACs, started to get hit, right? We saw these stocks now go down, 5%, 10%. Some of them were getting slammed 30%, 50%, right? Now we even see stocks like SPACs trading under $10, which is ridiculous, right? But at first, there's denial all over the place. We're saying, no, this is just a quick correction, 2%, nothing more than that for the NASDAQ, and we're headed back up for another year, right? That's what most investors think. But new investors didn't want to, believe that the party would ever end, right? Party started last year, March 23rd, and ever since we've been riding up until I think February 28th or so, it's been really, really good, nice and smooth path, but then people, begin to get angry, right? And you can see this on all social media. Jim Cramer says people are tweeting him, they get angry because, why is the market still going down? Right, and then why is Jim Cramer telling us to sell tech, and go into, cyclicals? What is going on? Well, we just need to buy more tech, right? They're getting angry at, even why people are posting negative stuff about the stock market, right? So somebody posts a video, oh, stock market's gonna tank, and then you get mad because they might have a big following, and then people start to sell, and that creates a bigger effect, right? So we see anger in that phase there. right? And then he recommended taking a profit at this time, but no one wanted to listen, which was another sign, right? Everybody was angered with what he had to say. And then we see bargaining, right? Bargaining is when we start to see like people actually starting to, research the companies. Why? People don't know the stocks they own, right? So all they're really looking for, so they start to research the company because like on the way up, you don't care what the company is. If you're making money, what the company does is obscure. It doesn't matter at all. But on the way down, you need to learn what the company is if you want to keep your money there, right? So that's one thing. People will start researching here in the phase of bargaining, okay? Understanding what the company really is on the way down. And then another point is that what else do they do? Well, in the depression phase, people or investors will also tend to, start saying that only if we had a rebound, I will sell all my stocks. I will break even, right? And this is such a common phase. Everybody's like, okay, trust me, if we get back to just where I bought it at, I'm going to break even, I'm going to sell it right away, get rid of it, and never come back, right? That's part of the bargaining phase here. You're just trying to get it to go somewhere. You're trying to get the sellers out, trying to, get back to your price you bought it at, and just break even before, losing even more money, right? And so then we have the phase of depression here. Depression is what we see, when names like the NASDAQ, don't do so well and may not be coming back. And when people start to actually internalize that and realize that, hey, these speculative stocks, maybe stocks that, Kathy Wood's ARK fund is investing in may not be coming back in the short term, right? Longer term, yes, that is possible. They're going to be, very, very good companies, but there is a lot of risk. These are very risky short stocks in the shorter term, right? And one really, really good point that Jim Cramer brought up was regarding NFTs, right? So how do we know we're in the depression phase? We've moved asset classes essentially, right? We went to stocks to now talking about non-fungible tokens and, moving away because we're seeing more appreciation here. That's just depression. Why? People are looking for other avenues to to make money, right? So they've realized that, hey, this is not the game I want to be playing. There's not that much money. So the younger crowd is now talking about NFTs because a lot of the NFTs are going up in value very quickly. So that also shows us that acceptance is coming, right? People are accepting that, hey, we're depressed with the stock market, just kind of keeps falling. We got to realize we have to change. And now they're kind of accepting that and then going into, either an S&P, maybe the Dow stocks or, the NFT market for real gains. And then he went into the do's and don'ts of investing here. Very good segment. First thing that he talked about was clearing your head. So what he said is that in the Confession of a Street Addict, he wrote about this too. He said that he sold everything, even at a loss, when he was, holding the wrong names at the wrong moment. Right here, these are the wrong names. These are the wrong names here. Tech, growth, and SPACs. Those are all names that we don't really want to be in these markets because, they're trading 100 times sales, not 100 times earnings, right? And a lot of these companies don't even have a product yet. And it's just kind of this idea, this theory that they're trading on hundreds of billions of dollars for some of these companies specifically. So he talks about clearing your head, right? If that means you have to take a loss in order to get into the right names at the right times, then you must accept that. You need to accept that is what he says. And then here, having a big cash position, not necessarily a big cash position, but 5 to 7% is always helpful. And you'll always see this in Jim Cramer's Charitable Trust. He says that you want to make sure you have a cash position. If things continue to go down past range, you have your price targets, you get in more and more aggressively. Also another thing is to, stop buying on margin, obviously, and then stop only betting or exclusively betting on options. They have been working since 2019. They've been working, and then I guess 2019 there was a little run there until March of 2020, and then after March of 2020, if you did options, there was another really good run there where you would have made a ton of money, right? But in this market, that's not the case anymore, right? It's not the case. So he says stop betting solely on these long-term options, or just options in general. And then he says do the homework, right? This is his classical phrase, right? It's not buy and hold, it's buy, hold, and homework, right? That's his classical phrase. Ask yourself, what does the company do, right? Do you know about their valuations, competitors' valuations in the industry? Do you know if those stocks, all your stocks trade together, right? If you're all in tech stocks, they'll all trade together, similar type of stocks, they'll all trade together. Do they have enough cash? Do they have a need to raise equity, right? And then kind of, Wall Street now values profitability, right? So that's the biggest thing. The great reopening stocks are going to be the focus because they're, Wall Street is so the tech growth and SPACs are out of the Wall Street fashion show. What are we looking for now? We're looking for heavily discounted stocks, like a normalized market where there's room to improve, right? And now we're in the sell the news kind of phase. What does that mean? That just means that when you get, people are selling based on the news before, okay, good news comes out, and people, continue to buy stock, buy stock, and keep running it up, right? Running it up and up. But now, people, you get some good news that comes out, you sell the news, take some of that profits, right? So kind of a normalized market again. And then he says the last one, wait for weakness. He just don't chase strength like we were in tech, growth, and SPACs, right? We were always chasing, SPAC, started at $10. It went to $20, that's fine. CCIV went all the way to $63, $65. Okay, we chased it somewhere here, we made a killing on our money, right? That works for tech, but not as much in these industrial cyclical reopening plays, right? So don't, especially in this market, you don't want to be, chasing strength anyway. You want to make sure you wait for weakness. In terms of his don'ts, right? Don't follow the hot hand. Specifically, he's referring to Cathie Wood's. Why people just follow the ARK fund because they release everything and because they're an open source model. And, they get into a lot of names without knowing the reason. So Cathie Woods might sell the stock, but you don't exactly know why she's selling. So you may make, irrationalized decisions because you don't exactly know the reason behind certain movements in the market. And then ignoring your surroundings is, very, very bad. You don't want to ignore your surroundings. Why? The economy can't be looked at in a vacuum, right? There is an expanding, rapidly expanding, economy, right? And that's going to be in our cyclicals, right? Our great reopenings, right? So in general, our economy is expanding, right? What this means is that it benefits these slower, boom and bust stocks or cyclical stocks, right? So you want to lighten up on these, secular in nature growth stocks, right? Which does good in a stagnant business model, but not in an expanding business model where, people want to go towards boom and bust stocks, right? So make sure that you look at the entire market as a whole, not just, ignoring the surroundings essentially. And then, he says another one is disregarding money managers. You don't want to be disregarding money managers. Why? They're very important. They have the ability to move the stock market, very simply said, right? And you kind of have to understand, what is, he says an earnings comparison, right? You have to understand the way these money managers talk so that way you're on the same page, even if you don't like them or disregard them. So that way you can understand everybody's perspective. Right? And then finally, or, second to last here, don't underestimate the difficulty of making money, right? 2020 was very easy, so we just start to throw in our money everywhere, right? But we have to realize that picking stocks in general is not easy, and it's unusual for stocks to just double, right? Now we have normalized, so that's not that common anymore. And then he goes into his final point, do not trust Wall Street, right? Wall Street is trying to, get you to buy anything, right? They're underwriting these SPACs left and right, 293 SPACs in the last 3 months, $92 billion raised. It's getting ridiculous, right? They just want retail guys to put their money into all these companies that they're making public, right? So make sure that, do not trust Wall Street, okay? Make sure you guys do your own research and things like that. And then as a bottom line here, just follow these rules. You'll have a good chance to prosper, right? But if you cling to what worked in 2020, well, it's not going to work. You're going to get blown out just because how the market has changed. It went from stagnant to an expanding market. And then for one of his, executive decisions, he had on Restoration Hardware, which had a very, very good quarter. They had top and bottom line beats, 22% revenue growth. They even saw a good forecast of 15 to 20% growth for this full year. One thing that I really liked and I would like to point out here is that they said they are not building houses, hotels. What are they building? They're actually building guest houses, right? And what we see throughout the interview is that they have kind of a different focus than just the general hotel market. And that's why they call it guest houses, right? They have a focus on privacy and they have a focus on luxury. Okay, and they say luxury is already there, right? Obviously with hotels. But with privacy, a lot of people don't have that. Why? Social media is essentially doesn't make anything private now, right? But people are gonna want to go towards something that's more privatized. Is essentially what they're saying. They're looking at the future, right? So they're trying to really be innovative in this space here. And then they say that, what they'll need to do is they'll need to create essentially a design statement and this experience that the world has just never seen before. And they say the CEO says that if he does that well, it will be like a breaking through force that, people at the highest levels of luxury will begin to respect their model. So he's trying to be innovative in this field here. And then he says during this process, they will be misunderstood tremendously just because they're, building a new path, right? They're trying to be innovative, so they're not taking an old path that already exists. So once they get seen over time, they won't be ignored, and over time, they'll actually be respected, right? But in the short term, they will be slightly misunderstood. And then he went into his next segment here, which was bridging the gap, which had to do with the infrastructure. So what do we know now? We know that there are, two leaders in this market so far, right, since November. One would be the great reopening plays, right? Our cyclical boom and bust stocks, right? We've been talking about that a lot. You want to get into these stocks. The other cohort would be the Biden plays, right? We know that the Biden plays are now actually slowing down, right? Names like solar, right? EVs, cannabis, they're all kind of slowing down in nature. This is because, they're all classified as secular stocks, right? So we still want to make sure that, Jim Cramer keeps pushing. Be in your great reopening place, be in your great reopening. Secular, you kind of want to get out of it. Why? Economy is not stagnant. Economy is expanding right now, right? But Cramer asks, is there a way to play both of these, right? These were both very, very good. They've been leaders, in terms of like these type of plays, the Biden plays and the great reopening plays. They've been the leader since last November. So is there any way that we can kind of play both of them? Well, what do we know that's kind of coming up? Well, we know after the stimulus, the next major policy project was that $3 trillion infrastructure project, right? This hasn't passed by any means, but it's going to be what the politicians are going to be talking about during this time. So what does that mean? Infrastructure names work, we know when the economy is accelerating, because at the end of the day, they are cyclicals in nature, right? So they are, going to be both reopening plays and Biden plays. Why? The Biden plays is anything that takes advantage of the Democrats' rule being in majority rule in the House, right? So they having the power to pass anything that might be more, liberal in nature, right? So they'll be able to pass EV cannabis laws. They'll be able to get into solar panels, right? Things like that. That sort of nature, right? What do we know is that Democrats, they want to pass, at least most of them, majority of Democrats want to pass a $3 trillion infrastructure. So it's a Biden play, but it's not that secular. Why? We're still in cyclical names, right? So you get the best of both worlds. Really, really nice there, right? So what are the names that he goes into here? He goes into MLM, which is Martin Marietta. And what are they? They are a supplier. They're a supplier of building materials like aggregates, asphalt, and even cement. And it's everything essentially that you need for roads, right? So just think about it, supplier for building roads. So that's what, Martin Marietta specializes on. And for that $3 trillion, infrastructure bill, they'll definitely benefit from that, right? And one thing that I really liked is that the company is focused on 11 mega regions, especially that, Austin, Dallas, and Houston region, which, Jim Cramer specifically pointed out as booming like crazy now with all these companies, Elon Musk, Apple, and all moving there, right? So they're focused on 11 mega regions. And what does that mean? That essentially just means that even if the infrastructure bill doesn't pass, hey, they're still in the best area, so they're going to be seeing a lot of growth in those few 11 mega regions, right? So we always have to come into it thinking that the infrastructure bill will not pass. Take the worst case scenario essentially. And then they have really, really, really big projects for really big companies such as Amazon, Facebook, and Walmart, which is obviously a very good sign despite, of what happens with the infrastructure package, right? And then we have inflation worries, right? Obviously inflation means higher prices, which is better for them because they can raise prices, right? And we know that they are up as a stock, 17% year to date, but they're only selling at 26 times next year's earnings estimate, which might be too low because they have beaten Wall Street estimates or expectations by an average of 22% for the last 3 quarters. Hear that. They've beaten Wall Street expectations by 22% for the last 3 quarters on average, which is very, very solid. So Jim Cramer says this, estimate, selling at 26 times next year estimate is not as bad as it may look. And then he goes into the second name here that you want to get into is Nucor, number one steel maker. We know that he's been on, he's been talking about it for the last 2 days. And then, what he says is that, hey, if the Congress fails to pass the infrastructure passage, they still have a huge demand for steel, right? They don't need the help of the federal government. So even if we take the worst case scenario where they don't get, big demand from the federal government, that's totally fine. Why? They are expected to report the best quarter overall because of their surging demand and rapidly rising steel prices, right? Because of the inflation. So regardless, they're benefiting, even if it doesn't pass in Washington. And we know that the next quarter, like I've been saying, is even better. The CEO came and said that on Mad Money, I think on Wednesday. And the stock is ridiculously cheap. We've talked about this before. It only trades at 8 times earning. So it is a buy. These are both the best of breed stocks if you want to get into both the reopenings and the Biden plays at this time, right? What's the take home here? What's our bottom line? Be careful. There's a chance that, this bill will stall somehow, or the projects will take longer than expected. But these stocks will work without Washington. Why? At the end of the day, they are cyclical boom and bust names. And then going into the no huddle offense here, what he kind of went into was this idea of the retreat of the retail investors, right? What do we know? Like, a lot of people are taking the market personally now, right? The biggest thing that he wanted to, touch on this point is that it's not personal, right? It's strictly business is how you want to think about investing in the stock market. But we know that people are getting too personal as the market begins to change, right? And we're really seeing that now. Regarding the retail investors, last year, 2020 in May, we saw that the hedge funds, they were proven wrong, right? Hedge funds were saying, world is going to end, guys, right? They were, shorting the market like crazy. A lot of them lost a ton of money because of that. But these, retail investors, these younger guys got their stimulus checks. This led to a lot of optimism. They started putting that into the market. They started to see good returns, right? Over time, they were making really good money. So it began to get personal. They're like, okay, well, if I can make money and also take down the Wall Street suits at their own game, isn't that even better? Right, so that's what we began to see here. We started to see that with Tesla, and now people were feeling really, personally invested in the stock. Some people bought it at $900, and it felt like $600, $650. So they really, really got hit there. And then, we also know that past that, there's just the short squeezes in general that people have got really passionate about, beating out these short guys, right, the big Wall Street guys. But Jim Cramer says, hey guys, now the world is normalizing. So we're in a market where stocks don't always go up. So you cannot be personal at all in this market. You must be very objective. You must remain objective and think about it as just strictly business, because stocks don't always go up. What do we know? We know that, hey, there's a supply glut, meaning that there's an oversupply of new shares, of new companies, especially in the tech world and growth world, right? Growth place. So make sure you identify companies, he says, that are into weakness, right? Buy stocks into weakness. Stocks, he says, his bottom line, are pieces of paper. You can't love or hate them, right? So that's the biggest thing. We got to stop making this personal and treat it as a learning experience. You lost the money, you booked your losses, you cut your losses, I should say, and you learn from that experience, right? We want to make sure that we're not trading stocks personally, but as a business. Hopefully you guys all enjoy the video and learn something new. I thank you all so much for your continued support. Make sure to go down below and drop a like if you did enjoy. Subscribe to my channel if you're new. Turn on post notifications so that we're aware of when I do upload my next video. Comment down below. Till next time. Peace.